traders, Raghee here, and in this update I'm going to answer a question that I get quite often, especially end of quarter and end of year, and that is the end of quarter, end of year shenanigans that we typically tend to see. In other words, how do we see some of the posturing around basically stronger stocks tending to gain into the end of the quarter and weaker stocks tending to get even weaker, ugly stocks getting even uglier towards the end of a quarter. And the reason is, if you're thinking about sort of the end of month timestamp, what does a portfolio manager show they have in their book as the quarter winds down? And one of the easiest ways to use recency bias, to use that what is looking good right now type mentality, a lot of times that's going to affect the end of the quarter. Right now, what I'm showing you is the 5-day look back on basically the U.S. sectors, everything from energy to real estate, staples, industrials, utilities, basic materials, financials, healthcare, consumer discretionary, communications, and tech. Right? And the thing that I'm noting is that the really two markets that are, as of the last two sessions, moving higher, like this and like this, are energy and financials. Now, I like looking at this view because it really makes the ebb and flow of different sectors, which of course are weighted within the indices, it makes it so much clearer. I don't think we're seeing a classic rotation situation here. I think that energies are benefiting because crude oil's been heading higher and because natural gas has been heading higher. And XOP has been a disproportionate benefactor to that. I mean, XLE is moving higher, OIH is moving higher, but XOP has really been winning the most because of mostly natural gas. Financials are moving higher, but you'll notice they've taken back a lot of the gains. We saw that gap up going into the 27th. And then you'll see where we are today, kind of back to even. Everything else has been meandering lower. By everything else, this is basic materials, industrials, consumer discretionary, communication, staples, tech. If we were seeing sort of this idea of rotation, what we're typically going to see, not always, but we're typically going to see XLP and XLU benefit if there's really a large risk aversion in the market. These are defensives. We've talked about this before in previous updates. And they'll usually benefit as names like XLK, SMH, XLCY, kind of your tech corner, move lower. And we'll notice that, say, for example, TNX, not that it's a defensive directly, but TNX is always also going to move higher while these are moving lower. So those are things that I look for. I don't know that we're getting a clean example of that at all, as you can see the way in which really only XLE is moving a lot higher. That's not a really great example of rotation, nor is it a great example of moving to defensives. If XLP and XLU are moving down with XLK and XLY, where is the money really hiding out? And I don't believe that it is. So I think there's probably a pretty good argument that there's likely a near-term bottom being put in. And let's also transition to industries. So it's another larger list. And now we're bringing in OIH, oil services, metals and minings, REITs, regional banks, gold miners. And again, I'm looking for the same thing. What is disproportionately moving higher? And there was, well, just like XLE, take a look at your top two names. And this is absolutely, again, related to the crude oil and natural gas move, especially XOP. That's your gas and oil explorers. And there's OIH, which, if you're wondering, what is OIH compared to XLE? That's the difference between Chevron, Exxon, Schlumberger, and Halliburton. Now, why would a futures trader need to know this? Because if we're really seeing risk aversion hitting the market, we're going to see that play out in what I believe would be organization into downtrends on not just the broader averages like the S&P and the NASDAQ, but also then in XLK, XLC, XLY, XLF, XLV. And yes, we are moving sharply lower, but this is likely the beginning of distribution. And remember that downtrends form just like uptrends form. One candle really doesn't make or break a larger reversal. In other words, if I'm looking at this one candle on this one red grab candle on the NASDAQ, yeah, I could say that's the beginning of the break of the trend, but by the second candle, I've got the confirmation, right? Do I see consistency in the red grab candles? No. Do I have lower lows, which could be perceived in a yellow choppy market as oversold levels? This being one, and then I would look to this low here, and then this low down in here. So in between this area, I'm looking at this market as being oversold. This is a distribution market. We also need to switch gears with our indicators. We need to switch gears and move away from more of our trend following indicators to more of our choppy market indicators. This is ready, aim, fire. This is a slow stochastic. We can also look at exhaustion levels on the V-score. But what you want to do is be very discerning about this. Are we in choppy markets? Lower level yellow on the JT multi, meaning that the 8, 13, 21, and 34 are now just spaghetti. There's no clear upside probability. There's no clear yet downside either. This market is stuck in a range. So that's the way I'm going to treat this. And this is really the first time since, a prolonged distribution. It's been a little while. This is probably the first real distribution confirmation that we've seen in some time, where I've got the numerous red grab candles, at least two, accompanying the yellow JT multi. That's a really easy formula to follow. Do I have at least two red grab candles, and are we yellow on the lower JT multi? When I get that combination, we're probably in chop. Okay, that's transitioning out of the trend. And so how much does this have to do with the shenanigans at the end of the month? I don't think as much as some traders might think, because I'm seeing names that were strong moving lower. I'm seeing names that were weak moving lower, and we're not seeing rotation either. So it's not, if it's not month end of month positioning, if it's not sector rotation, let's not presume the downtrend is coming, and let's not presume we have a clear view. Remember what's happening this week. We are inundated with Fed speak. We have growth, GDP numbers. We have PCE, inflation numbers coming out. So the market's very rightly finding a range. It's been choppy for a while. This is not a brand new choppy market. So I think it really does behoove us to be patient here and try to find, and we'll dive into this more in the premium video, and we'll dive into this more on the webinar that I have coming up on October 6th. It probably behooves us to look at some defensives. It behooves us to keep looking at the strength in the market that is really blatant: crude oil, natural gas. And it also would behoove us to look at lower weighted stocks within some of these sectors. In other words, if you have a sector that you like or you think that could recover, try to find a lower weighted stock within it. And I know this video went a little long, but if you like topics like this, please join me in the morning, 9 a.m. every morning for Charts and Coffee. We'll dive into this. Everything we're talking about is something that most retail traders know. Everyone knows end of quarter, end of month, we have shenanigans, right? And end of quarter, end of year, end of month, we have shenanigans. The shenanigans are going to create a certain amount of higher volatility that should very naturally get us to not start to foretell what the market is going to do, but rather, I think it makes sense to be a little bit more discerning. And our watch list should also automatically start to contract. We're not going to have the same number. If you're frustrated right now because the trades just aren't happening at the same clip as they were from here to here, that's normal. That's healthy. Your watch list right now likely is not going to be as large as it was back in here. These are just things that I want to make you aware of to hopefully just give you a little peace and calm, and just realize that, okay, I'm just going to wait for this market to figure out what it wants to do. I'll take advantage of oversold lows. I'll take advantage of overbought highs, and I'll transition from the trend following that's been working pretty much since March, April to now a distribution choppy market. Okay, hope that helps. I'll see you in Charts and Coffee at 9 a.m. We do it every weekday, Monday through Friday. And remember, you can register for my next webinar coming up on October 6th at simplertrading.com/trend. Thanks as always for the time. If you have any questions or comments, please leave them below. I do check them on a regular basis and answer them right here. Okay, be good to each other. Hey traders, Raghi from Simpler Trading. Thank you so much for watching this video. Be sure to leave a like and a comment below. And remember, subscribe and click the bell icon so you'll get notified of the next update. And when you're ready to join me for live trading, be sure to head on over to simplertrading.com. I'll see you in the next update.